Perfetto. Devo schiacciare preso, mi esce anche a te ti esce, Andrea?
Sì, preso, esatto.
Lo devo schiacciare?
Sì, l'ho schiacciato io.
Perfetto. Dimmi tu quando posso partire.
Io comincerei, Sasha, adesso ho chiesto conferma, però.
Ok.
Sì.
Iniziamo, aspettiamo 2 secondi, parto e poi ti lascio subito la parola, Peter, ok?
Ok.
Perfetto. Inizio. Saluto i partecipanti che piano piano si stanno connettendo, fra pochi secondi partiremo. Ecco, direi che possiamo partire. Buongiorno, buongiorno a tutti, benvenuti a questo nuovo appuntamento, a questo nuovo webinar organizzato dal Centro di Competenze Tributarie della SUPSI. Parleremo oggi di digitalizzazione dell'economia e delle conseguenti challenges a livello fiscale, quindi di implementazione della cosiddetta Action 1 del BEPS. Non mi dilungo oltre su quello che è la presentazione del webinar e anche di quello che sono poi i partecipanti. Lo farà direttamente l'avvocato Peter Altenburger, a cui dedichiamo un quarto d'ora di introduzione dopo la mia piccola introduzione, il mio piccolo saluto a nome della SUPSI. Da parte mia ci tengo inizialmente semplicemente a ringraziare i nostri partner, la Master, la SUPSI Alumni, la CF, la SVIT Ticino, Fiduciari Suisse, AITI, nonché AIF, le aziende delle imprese familiari del Canton Ticino. A voi, cari partecipanti che ci seguite, come di consueto sarà possibile porre delle domande orali direttamente ai relatori. Lo potete fare quando? Al termine, direi, di ogni relazione. Come? Ormai siete abituati, lo sapete, attraverso il menu che trovate in basso sui vostri teleschermi con l'opzione alzata di mano. Sarò poi io a monitorare se avete la mano alzata e vi aprirò e vi chiuderò il microfono. Da parte e a nome di SUPSI e del Centro di Competenze Tributarie, grazie di cuore per essere con noi. Oggi abbiamo con noi degli ospiti illustri, ripeto, lascio poi a Peter Altenburg la presentazione e non mi resta altro che augurarvi 2 o 3 ore di studio. Grazie e a dopo. A te la parola, Peter.
Thank you very much, Sasha. This is a great day and a great pleasure because I think the bulk of the speakers of today's conference are somehow related to the University of Michigan. I was there, I wouldn't tell when it was, but it was many years ago, and I still remember vividly my learning experience there, and especially when I asked as to whether I could listen to the tax course, I was told no, everything else you can listen, but not to the tax course, that is too complicated for you. So that is obviously a good start for having Reuven Eviayona with us. And I think, you know, the technology made it possible to have you to join this extraordinary meeting here. And especially at time of Corona, where technologies help us to bring us together, important people, without them being obliged to travel. And I understand that in times of, as we have now, you would never in your life come to Switzerland physically. So we appreciate you being there. And obviously, I leave it up to you how long you want to assist your foreign professor speaking here. And obviously, we make the questions immediately after your topic, so you can leave at any time, whenever you want. And with this, I would like to welcome, as I said, Ruben Everiona, and he is a tax professor at University of Michigan in Ann Arbor. He specializes in corporate and international taxation. He has served as a consultant to the US Department of the Treasury and the Organization for Economic Cooperation and Development, the OECD, on tax competition, and is a member of the steering group for the OECD's International Network for Tax Research. And with these words, thank you very much for joining us. I'll pass the floor immediately to Ruben.
Thank you very much, Peter, and thank you everybody for being here. Greetings from today's sunny Ann Arbor. I will talk for maybe about 20 minutes. If people have questions and they want to raise their hand in the middle, that's of course fine with me. Let me just share my screen here. Here we go, share. All right. Slideshow. Okay, so this is entitled US Corporate Tax Reform and International Perspective. And the timing this week is maybe propitious, although maybe next week would have been better, because as we speak, there are active negotiations going on in the Congress. And there's even a chance that there will be some agreement in principle on international tax reform, among many other things, before President Biden leaves for the G20 meeting on Thursday in Rome. So in order to start, I want to give a little bit of an introduction to the way US international tax works after the big 2017 tax reform, the Tax Cuts and Jobs Act. Because I can't assume that everybody in the audience necessarily knows all of it, and you need to know some of it in order to understand what's going on now. So the first big thing that happened in 2017 was a cut in the US corporate tax rate from 35% to 21%, which is of course a very significant cut. But in order to finance that, because the Republicans in Congress were limited to not cutting the budget, not increasing the budget deficit for more than $1.5 trillion over a 10-year period, there were several elements that were introduced, especially on the international side, in order to raise revenue to offset some of the revenue loss from the tax cut. And the first one was the so-called GILTI provision, Global Intangible Low Tax Income, which was a 10.5% tax, that is half the normal rate, on all the income of controlled foreign corporation above a certain threshold, and the threshold was a 10% return on their physical assets, which is termed QBI, Qualified Business Asset Investment. So essentially, if you're a US multinational with controlled foreign corporations overseas, you take all of those CFCs together as an aggregate, there's no country by country element here, and then you calculate how much their physical assets are worth, and you calculate 10% of that, and that amount is completely exempt, because one big innovation of the TCJA was that that amount is exempt even when it is repatriated, as opposed to the previous rule, which was that you had to pay tax if you repatriated income. But of course, the important point is that most US multinationals, most of the big ones, don't have a lot of tangible physical assets offshore, because most of them are primarily about intangible assets. So if you think about Facebook and Google and Amazon and Apple and so on and so forth, they don't have a lot of physical assets. So the exempt amount, at least initially, was likely to be relatively small. And that means that they're subject to GILTI on almost all of their foreign source income at 10.5%. Then the next point is that there is limits against the application of foreign tax credits against GILTI, which did not apply before. And that limit is 80% of the foreign taxes paid. So you can't credit more than 80%. What this translates into is a 13.125% effective rate. So if, and you can do the math, but basically, if the foreign tax is 13.125% or higher, then there's no GILTI due, because 80% of that is 10.5%. So the foreign tax eliminates the GILTI liability. And this is done on a worldwide basis, that is everything aggregated together. So essentially you can average situation where there's higher tax and situation where there's lower tax and so on. But if there is no foreign tax, as a lot of these multinationals really paid very little before TCJA, then you have to pay the GILTI. And importantly, if there are losses, you don't get to carry them forward. That is, and everything is current. The other thing about the foreign tax credit is that you can only take foreign tax credit for the current year. No carrybacks, no carry forwards either. This is all different than the way it was before. Okay, so that's GILTI. And the other important innovation in TCJA was the BEAT, Base Erosion Anti-Abuse Tax. And this is an inbound tax, and it's a 10% alternative minimum tax that applies to certain payments made to foreign-related parties at a 25% threshold with revenues from the United States that exceed $500 million. So it's basically only big foreign players are subject to the BEAT, and only if they have related parties in the US, that is basically US branches or US subsidiaries. And the way the BEAT is calculated is that you basically take the normal tax base after deductions, and then you add back various deductions, primarily interest and royalties, but also, for example, insurance premiums. And you do that in the case of the insurance premium, for example, without any offset for insurance losses. So you can have a situation where you're subject to a lot of BEAT, even though you don't have really any net income from the United States because there's no offsetting. The other really important thing to know about the BEAT is that no foreign tax credits are allowed about the BEAT at all. So you can have a situation where you have a company with, let's say, a relatively small BEAT liability initially, but then if it has a lot of foreign income, since there are no foreign tax credit, that increases the base for the BEAT, and you have a much bigger BEAT liability than the normal corporate tax liabilities. And fundamentally, the important thing about the BEAT is that it's an alternative minimum tax. That is, you need to calculate that, you need to calculate the normal corporate tax, and then you pay whichever one is the higher. And if you have any liability for the normal corporate tax, you deduct that from the BEAT, if the BEAT is higher. Now, importantly, also, it also applies to payments from US parents to their controlled foreign corporation, not just to foreign parties. So any foreign related party, including a CFC, if you make payments to them, you're subject to the BEAT. So those are the two big innovations of the 2017 tax reform. GILTI raises quite a lot of revenue. The BEAT much less, that is, it raises less than what was anticipated. And a major reason, I mean, there are various reasons for that. One is that people have reconfigured their business to avoid the BEAT. But another major reason is that the BEAT applies, as I said, to interest, royalties, and various other things, but not to cost of goods sold. And I suspected what people have been doing is that they kind of bundle their interest and royalty payments inside cost of goods sold, and as a result, they're not subject to the BEAT. And so the BEAT has been raising much less than anticipated, whereas the GILTI has raised quite a bit over time. Okay, so now let's take a look at what the Biden administration has proposed, which was a proposal that they issued last March and then elaborated it over time. So, and many of that will not survive the congressional process, which is normal in the United States. The administration proposals usually are significantly modified as a result of having to get them through Congress. But it's important to understand, by way of background, what it is that Biden was proposing. So the first thing was to raise the corporate tax rate back to 28%. It's not all the way to what it was, which was 35, but significant rate from 21 to 28. And the next thing was that the GILTI rate, which used to be 10.5, is raised to 21, which is quite high. This is now supposed to be 75% of the normal rate, right, instead of half. Then there's an elimination of the QBI, that is the tangible assets exception. there's not going to be any exemption at all, according to Biden. That means no exempt amount either. Also important, the GILTI will be applied country by country. That is, you separate out high-tax countries or low-tax countries, no average. And then on the BEAT, the idea is to replace it with something they call SHIELD, which is essentially a conditional deductibility rule. That is basically, you get to deduct all of these things that the BEAT applies to now, only if there is adequate tax in the residence jurisdiction. And those of you who follow Pillar 1 and Pillar 2 can already see that this, for example, is the under-tax payment rule of Pillar 2. Now, as I said, much of this is unlikely to get enacted as is, although some of it is reflected in what's going on in Congress too, and I'll get to that in a moment. But we're also likely to get something enacted by the end of the year, simply because otherwise the Biden administration doesn't get anything through, and that is not something that the Democrats, I think, would appreciate. So, and this, now there's been real progress. I mean, this week is kind of a crucial week, because by the end of the week, there's supposed to be a real framework for a smaller bill than was proposed originally. It's about $2 trillion over 10 years, but that's still significant. It's similar in size to what the TCJA was, and it's supposed to be entirely offset by revenue raises. That is, not increase the deficit even a cent, and that's of course significant because you need to introduce significant revenue raises in order to get them. So now this chart illustrates what the current law is on various things, what the Biden administration budget, which I just went through, proposed, what Ways and Means, which is the House of Representatives Committee, proposed, what Senator Wyden for Senate Finance, he's the chair of Senate Finance, proposed, and then how it compares to what the OECD wants to do in Pillars 1 and Pillar 2. So first of all, there's the GILTI minimum rate, right? Which currently is 10.5%. So that's obviously not enough, because the OECD wants 15 under the agreement that was released earlier this month. So the Biden budget, as I mentioned, wants 21, which is significantly higher than that, but the congressional proposals are lower. Ways and Means talks about 16.5%. Wyden talks about 18 to 19%. It's, in any case, it's likely to be above 15, and that means that the US will be compliant with Pillar 2, which is, in any case likely, because Pillar 2 is really, unlike Pillar 1, which we'll get to, but Pillar 2 was written significantly to follow GILTI and BEAT and to essentially follow what the US has been doing. Then there's the question of the exemption. Current law, as I said, is a 10% return on physical assets that you buy. The Biden budget eliminates that altogether, 0%. Ways and Means talks about 5% in general and 10% in US territories, and Wyden eliminates it just like the Biden. The OECD proposal, as you know, has a exception for substantial presence in Pillar 2 for 7.5% of physical assets and payroll, reduced to 5% after 5 years. So here, I think, again, it really depends how it's going to be drafted. The Ways and Means proposal is the most similar to what the OECD is proposing. The other ones, Biden and Wyden, are significantly harsher on multinationals. Then there's a question of the foreign tax credits. So under current law, you get 80% with no carry forward. Same in the Biden budget. Same probably in the Wyden proposal. Ways and Means says 95% and with carry forward. And in the OECD, 100% and carry forward. So here, the OECD is significantly more generous than any of the proposals that are on the table. Fundamentally, the American view is generally that we don't want to give 100% credit anymore, because that encourages foreign countries to raise taxes or discourages American multinationals from trying to reduce their foreign tax liability. So it's not likely that we'll get 100% in this. Then there's a question of how losses are treated. So again, under current law and under the Biden budget, losses cannot be carried forward. Under the Ways and Means proposal, and maybe widen, they can be carried forward in the OECD version, they can be carried forward. And then there's a question of whether it applies country by country, which is not true now because everything is aggregated together. It is under all the proposals, except for Biden, I'll get to that in a moment. Biden and Ways and Means allow for country. The OECD requires country from country. So US law here must be changed in order for the US to be compliant. Wyden does something interesting. They don't do country by country, but they do a high tax exclusion. So basically, if the foreign rate is high enough, that gets excluded from GILTI. Everything else gets separated and is subject to GILTI. In some cases, this is actually less generous than country by country, but I'm not sure whether that will survive the congressional negotiations. Okay, so now we finally get to the point of what we're supposed to talk about, which is the interaction of all of this in the US with the OECD pillars, Pillar 1 and Pillar 2, which were negotiated with the agreement of the administration. Now, as far as Pillar 1 is concerned, it's really unclear whether Pillar 1 can be enacted in the United States. There's a lot of uncertainty about this. The administration seems to think that there's a way to get it through, but from everything that I've heard, there's a lot of uncertainty. The basic problem is that Pillar 1 requires amending every tax treaty in the world, basically, because Pillar 1, Amount A, is not dependent on the permanent establishment threshold and not dependent on the arm's length standard. Amount B is easier because that's like the treaties. But Amount A requires overriding every treaty or changing every treaty. Now, outside the United States, this is supposed to be done by a multilateral convention, right? That countries will ratify according to the normal constitutional procedures in the EU. I'm guessing there'll be a directive of some sort. And this will simply amend the treaties accordingly. But that's almost impossible to do in the United States currently, because in order to get a treaty through, and this is a treaty, you need a 2/3 majority in the Senate to ratify it, 67 senators. And there's no Republicans that are willing to vote for this. So you only have 50, so that's that, a treaty. There's another way of doing it, though, which is what's called an executive agreement, and specifically a congressional executive agreement. Executive agreements are agreements that are negotiated by the executive branch, by the president, and then enter into the force of law once they're ratified, once they're agreed to. But if it's only by the president, then the next president can reverse them, which is exactly what happened, for example, with the Kyoto Accords and with, the Paris Accords and various other things that the Trump administration eliminated once that Obama negotiated, for example. And so you don't want to do that because, who knows who will be president after 2024. But there's another way, a better way of doing it, which is what's called a Congressional Executive Agreement. And this involves legislation, regular legislation that passes through both houses of Congress, but it can be passed with a normal majority that is only with 50 senators voting plus the vice president and the normal majority in the House. And it authorizes the president to negotiate such an agreement with certain terms. And then that can only be changed by subsequent legislation. So if the Republicans win, they need to pass legislation to abolish it. So it's stronger than just a mere executive agreement. But there's an issue, and that is unclear, which is that in order to get this through, you need to do something called reconciliation, which is what the Republicans did in 2017, and before that was done for example, Obamacare in 2010. I mean, most legislation in this century in the United States, most tax legislation for sure, were done by reconciliation, which overrides the need to get 60 votes in the Senate. You only need a simple majority. But in order to do reconciliation, you need to pass something called the Byrd Rule, named after Senator Robert Byrd of West Virginia, and that is actually in legislation in the Congressional Budget Act of 1974, so you cannot change it without changing legislation, and that's subject to 60 votes in the Senate, so you can't really change that. And what the Byrd Rule says is that nothing done under reconciliation can be passed unless it affects the budget directly. Now, the problem is that in order to amend treaties, you need to have a treaty override, and there is a significant number of commentators who think that in order to do a treaty override, you need an explicit statement in the legislation that it's an override, because there's Supreme Court authority that says basically that Congress cannot override treaties by silence. You need to say so. And the problem is that most people think that saying so is impossible in reconciliation because it doesn't satisfy the Byrd rule, meaning it's not directly affecting the budget. So you can't do it because the Republicans will raise a point of order and get it. Just to illustrate, the name Tax Cuts and Jobs Act itself was eliminated from the Tax Cuts and Jobs Act, which is what everybody calls it, because it doesn't affect the budget. So the segment of the law that calls it that was eliminated, and as a result, it doesn't have a name. It's public law something something, but everybody calls it the Tax Cuts and Jobs Act, right? But here it's more serious, because if you cannot override the treaties unless you say so explicitly, and if you cannot say so explicitly, if you have reconciliation, then it's not clear that this can pass at all. Now, there are other people who say you don't need this. I mean, for example, I don't think you need an explicit statement, but that's just my opinion. And in addition, it may be different from congressional executive agreements because that's like a treaty. And the explicit statement rule was done for laws, not for treaties, regular statutes. So possibly, in any case, this will be litigated probably all the way to the Supreme Court, possibly, and that will take years. So all I can say is there's significant uncertainty about whether Pillar 1 can get through Congress. And it needs to get through Congress in some fashion in order to be implemented in the US because it requires changing the treaties. Now, I think, however, that this is not such a serious problem as one might think, because I don't think you really need the United States in order to implement Pillar 1. The main target of Pillar 1, of course, are the American tech companies, right? That's why Pillar 1 exists. Now, it's not just that, because there's comprehensive scoping and it's all big companies and so on. But nevertheless, I suspect that a large percentage of them are American. And we'll get to the question of foreign companies selling into the United States in a moment, but certainly, most other countries are doing this in order to tax Facebook, Google, Apple, etc. Now, how do they do it? Well, I think the way that they will do it is to negotiate this multilateral convention and to have the multilateral convention change or override the treaties. This is very easy to do in dualist countries like, the UK and New Zealand and Australia and Canada and so on, where all treaties can only be incorporated into law by legislation, and later in time trumps earlier in time. In the EU, I suspect this will be done by directive, and directive changes domestic law, as you know. Outside the EU, if you have a monist country, it may be more difficult, but I still think that you can amend things by treaty, just like by agreement. And I think they will apply this to the US, and if necessary, maybe even terminate the tax treaties. I don't know, but in any case, they will. I don't think there will be a situation where Pillar 1 is implemented outside the US without applying to US companies, because that will miss the whole point. And at that point, the United States will face a choice. And the choice is basically, what do we do about the fact that now our companies are going to be taxed under Amount A by all of these foreign countries where they're selling stuff? And I think under those circumstances, the United States will essentially agree, just like they agreed to the statement of principle this month, to give foreign tax credits for Amount A, meaning Amount A is a legitimate exercise of source country revenue authority, and therefore we recognize giving foreign tax credit. And the amazing thing is that I understand that this week or last week, the United States agreed in principle with Italy and various other countries to give temporary foreign tax credit for DSTs, right? So that's a very big deal. Now, this is temporary because it's supposed to go away in 2 years and so on. But the Trump administration changed the regulation explicitly to disallow credits for DSTs. So this is a big concession by the Americans. And therefore, I also think that the administration will make sure, because foreign tax credits essentially can be done without legislation. This is just an internal thing that has to do with the regulations under the code. What taxes qualify and what taxes don't qualify. There was a story, for example, with the Italian IRAP back when this was done by treaty, but you could also do that. You could recognize various taxes by legislation as creditable, and I'm pretty sure that this will be done. Then the other interesting question under Pillar 1 is, what about foreign companies that sell into the United States? Now, I don't know how many of those there are, but there certainly are some. I think Siemens, for example, is probably selling enough directly into the United States. The Taiwanese chip-making company, whose name I forgot, is probably selling enough into the United States to be subject to Amount A. I find it hard to believe that the United States would not implement Amount A. Now, in Taiwan, of course, there's no treaty, but even in the German situation, if the Germans are going to tax Facebook and Google and so on, we're going to tax Siemens for sure. So I think Amount A can be implemented without a congressional action. That's the main point here. Now, Pillar 2 is much easier, because Pillar 2 is just a global implementation of the guilty and the beat. Doesn't require any treaty changes. I mean, it just requires legislation. And as we've seen, all the legislation that's now on the table in the US basically complies with the OECD minimums. That is, the tax rate on the guilty will be higher than 15. It will be applied country by country. The shield is just exactly the under-tax payment rule. And even the beat, I mean, even if that doesn't go through, I think something will go through, but I think the guilty and the beat can be grandfathered probably under existing OECD rules. So I think that that's easy. Pillar 1 is hard, Pillar 2 is easy. In principle, they're linked together politically. In principle, they can be separated. You can do Pillar 1 without Pillar 2. But I think that there will be a way of doing Pillar 1 too. And at this point, I think I will stop and listen to what other people have to say and take questions and so on. So let me get out of the slides and just do that. Stop screen sharing. Here we go. Okay, and that's that.
Thank you, Reuven. This was a candid explanation of where things are in the United States. And one easy question to start with would be, how serious is that whole shield exercise, which to my mind, countries like, for instance, Switzerland, we will obviously have no way to adapt to this tight time schedule as will be imposed by the OECD and will be imposed by the Biden administration. And sort of we fear that we will take longer than that, and will then be something which is there to sort of, how should I say, to encourage the latecomers to act a bit slow, a bit faster.
That's the idea. The administration is very much behind SHIELD. I mean, precisely because they're trying to encourage various foreign jurisdictions to adopt minimum taxes and so on. I don't know what will get through Congress. I mean, the current proposals are not SHIELD. The current proposals in Congress are changing things about the BEAT, usually making it easier, actually. For example, allowing foreign tax credits against the BEAT, maybe fiddling with it in some ways, but it's not SHIELD. There was some discussion in the Senate Finance that they want to amend things so that they will be consistent with SHIELD. My sense, I'm not inside the negotiation, but my sense is that they probably won't have time to implement SHIELD the way the administration wants it implemented, because this is really a rush job now. They want to have a framework this week, and they want to get everything passed with this week before the president leaves for Rome. That's what they say. I mean, whether that will happen, nobody knows. But in any case, it's fast. Some kind of framework needs to happen this week because it's linked politically to the infrastructure bill, which the Republicans actually support, but the more liberal Democrats will not vote for it unless there is a framework for the reconciliation bill. So it all gets very complicated, but fundamentally my sense is that SHIELD as envisaged in the administration budget will not happen. So you will be subject to the old BEAT rather than the SHIELD, maybe with some modifications. And my sense is that countries have learned to live with the BEAT somehow. It was supposed to raise a lot of money and it isn't, which is always a sign that taxpayers have adapted to it. Although I'm pretty sure if you think about a company like Zurich Re, that they're suffering from the beat. I mean, that I've heard, that insurance companies hate it because, you know, they pay tax on their American premiums and they don't get to offset losses.
Okay. Any questions, gentlemen? Please go ahead. Nicola.
Invito anche i partecipanti dal pubblico ad alzare la mano qualora avessero delle domande. Non vedo mani alzate, comunque continuiamo a monitorare, Peter.
The next question will be, so here we follow more or less a little bit what has been said by the OECD. And we have heard that 136 countries, or 95% of world's GDP, have agreed on this 15% rate. And that was signed by Switzerland, and that was also signed by the United States. So what does then that mean? Is that a commitment for the United States, or is this a sort of lip service, or what is it?
That's definitely a commitment as far as the administration is concerned. And as I mentioned, every single proposal in Congress by the Democrats puts the GILTI rate above 15. How much above 15 remains to be seen. The administration wanted 21. That may be a little high, but the lowest that I've seen in Congress is 16.5. And that means that all American multinationals at least will be subject to, and they all, or almost all of them, also eliminate the exemption amount that you buy. So that means, you know, 16.5 on all income of all American multinationals on all of their subsidiaries, all CFCs, country by country. And that's, I think, entirely consistent with the agreement that was made in October 8th.
Okay. Are there questions from the public?
Posso immaginare che magari qualcuno, Peter, sia timido o abbia difficoltà a porre domande in inglese, quindi siete benvenuti a porre anche domande in italiano e poi
le traduciamo in inglese.
Senza problemi.
In the meanwhile, can I make a question? So, Ruben, you spoke about the foreign tax credit. So my understanding is that under current rules, there is no possibility to have digital service taxes credited in the United States because it's not an income tax, basically. And I'm not sure, I did read the agreement as you did read, so I'm not sure it is a credit that the US will give based on the agreement we were talking about, the one of 5 days ago. I think that is more like an agreement of this, a credit given by the source country, but maybe I'm mistaken. I mean,
it's hard to understand this.
It's not something that has been announced, so it's difficult to say, right?
Exactly. I mean, what I've read, and this I have to say is I've read this in the Wall Street Journal and various American. I mean, this is not exactly a 100% foolproof source, but on the other hand, is that the administration has agreed for the transitional 2-year period before all the DSTs disappear to give a credit against American tax for the DST, which, if that is true, is a very big turnaround from the way the Trump administration did it, because the Trump administration actually amended the regulations to make that impossible. And this, I mean, if they want to do it, they can do it, I think, because I can't see how anybody will have standing to challenge this. That is, this benefits taxpayers. And I don't think the Republicans or anybody else can challenge this in court if the IRS just decides to allow this credit. There have been examples like this before. There was a famous instance of the, for example, Mexican asset tax, which was, they just issued a notice that they're going to credit it, even though it was inconsistent with the regulations. There was a case with the Puerto Rican tax that they did the same thing. So I suspect if they want to do it, they'll issue a notice that for the transitional period, the DSTs are creditable against American tax. This will, of course, be cheered by Amazon and the rest of them that, you know, pay it currently. And it's essentially a way, but it's conditional upon it's going away in 2 years, that's clear, and on the multilateral agreement coming into effect, and et cetera, et cetera. So I think it's plausible to think of it this way, as kind of a way of encouraging, and it's certainly something the administration can do if they want to do it. It might not be politically popular in some circles, but the tech companies will cheer it. And I'm not sure, and the reality is that we're talking about small amounts, right? None of these DSTs are really that high. And maybe they're passed on to consumers anyway in some cases. And so it's more of a gesture of goodwill than something that will really cost the American Treasury a lot of money, right?
Yeah, I think the target revenue of digital service tax is a bit more than 200 million euros. So it's really a small amount.
Something, but we're talking about trillions now, so this is not so.
Well, my question then would be a more general one, and I think here also in Switzerland, basically we are streamlining and going ahead on this Pillar 2 taxation. And we basically have no clue in Switzerland how we would go about enacting Pillar 1. And you have signaled on your side a whole battery of problems which you raise on the Pillar 1. And really my question is it conceivable that we have something where Pillar 1 dies slowly and then really we go ahead with Pillar 2 and that's the end of the whole exercise?
My personal view until the statement was that this is the most likely outcome. And even now, I still think that that's more likely than not, simply because I see lots of problems with Pillar 1. It's not just the American problems. There are problems everywhere because, Pillar 1 hinges on the successful negotiation of a multilateral convention in the next couple of years, right? And that's hard. The multilateral instrument of the BEPS 1 was not easy to negotiate, but it was much easier because it didn't involve substantive changes. It was more of a procedural kind of thing, and it was all elective. Countries could opt in, opt out, and so on. Other than the PPT, there's almost nothing in it that is a minimum standard. Here, essentially everybody needs to sign on to this. And one problem, fundamentally, the reason Pillar 2 is so much easier than Pillar 1 is simply because Pillar 2 is really fundamentally an agreement among the G20. And they are the headquarters of 95% of multinationals. And if they agree, it's just going to happen. And it's called elective, right? But they all are going to sign on to it. Pillar 1, on the other hand, you really need, almost all the source countries to sign on to it. And that's a very difficult exercise. So my own view is that even though they're kind of politically linked together at the moment, it is quite plausible that Pillar 1 will die, like you said, a slow death, and we'll be left with Pillar 2, which I'm not sure is the end of the world, frankly. I think countries that want to, the big market countries, can probably find a way of implementing something like Pillar 1 unilaterally. The Indians had a proposal until recently that would do exactly that. They've kind of put it on ice at the moment. They probably will be able to revive it. And then there's the DSTs, which are also kind of spreading. And absent Pillar 1, they can continue to spread. And, the Americans can give a credit for those too, because as I said before, it's not very expensive.
Any further questions in Italian where we can translate? May I have a question here a little bit out of context and out of the blue? Because you, Reuven, you are famous for not being really a friend of arm's length transaction by transaction, and you have been made your way through this issue for many years now. And I think if it's up to you, then one would end this transaction by transaction issues immediately. And what are your feelings how these issues will evolve in this Pillar 1, Pillar 2 context?
Pillar 1 is an implementation of, as to Amount A, which is of course only only for big multinationals, and it's only 25%, and it's above a minimum threshold and all of that. But as far as the amount that was actually being talked about, it's basically, single factor sales formula. So, you just take an amount and you allocate it to all the countries where there are sales according to the percentage of sales in each country. So this is, in my opinion, a derivative of the way the US states have been doing it since, 100 years ago. And it's consistent with what I've been pushing, for 30 years or so. Because what I've always said is that, the arm's length standard depends on finding comparables. If you don't have comparables, it's not meaningful to say that something is arm's length or not arm's length, because you can't prove it. I mean, how do you know what unrelated parties would have done if you don't have comparables? Then any result can be arm's length, basically. So what Pillar 1 does, as far as I can see, is it basically uses comparability to the extent that possible, meaning, for the base amounts, and then for the residual, which probably there aren't any comparables for these large IP intensive companies, they just allocate by formula, and the agreement has been to allocate essentially, 75% of the residence countries or the production countries or wherever, and the other 25% of the market. Personally, I would have liked to see a 50-50 split, not 25-75, because I think that's more reasonable in terms of the relative contribution of the, source and residence or production and market. But this is a political agreement, and that's what they agreed on, and that's fine.
So your 50-50 is you add income on both sides and split it by 2.
That's basically, yeah, that was my idea. That's, I think, how a lot of states do it now. They double weight the sales factor, but there are a growing number of states that do it exactly 100% sales, simply because they like to tax imports and exempt export.
So we have 2 questions.
Yes,
the first one is from Andrea Brignoli. So.
Hey, hello everybody. Thank you, Professor, for your nice lecture. I got very limited understanding of US tax system, but I'm wondering why one of the main blocks of the pillar for here in Europe for understanding the US tax system is subpart F and the checkbox rule. So my question is, what's the relation between now check the box rule and guilty, of course, regarding intangibles?
The point of guilty was to eliminate the benefits of check the box. I mean, before, the way US taxation, international taxation worked before 2017 is that essentially we had a territorial system because of check the box. That is, check the box eliminated the old CFC rules, so-called subpart F, by enabling, so that the way this worked was that you had the US multinational with a top CFC in some low tax jurisdictions, and then beneath it various other CFCs in various high tax jurisdictions, but all of these CFCs were checked the box to be branches of the top CFC. And that meant that from an American perspective, you can pay interest and royalties and everything else from one CFC to another, to the top CFC, shifting all the profits from the high tax countries to the low tax countries, and have no US tax liability because of check the box. This all was eliminated under guilty. I mean, as far as the guilty rate is concerned, because guilty now applies to all the CFCs as a group. So it doesn't matter whether they're branches or CFCs or whatever. I mean, you just take the entire multinational and apply guilty to it. So even though the old rules still exist on paper, I think they've been kind of overtaken by guilty, although there are some circumstances, without going into too much detail, in which you can affirmatively tax plan to avoid guilty and enter deliberately into subpart F, especially if, at least the way the Trump administration implemented it, if the foreign tax is high enough, if it's over 90% of the American tax, which is basically 18.9%, then you could get out of guilty altogether. I think the Biden administration is likely to reverse this because that has no basis at all in the statute.
So that means that check the box really is still there on paper, but it will not be used anymore because it is overridden by guilty.
Exactly. I mean, on paper, check the box is now codified. It used to be just a regulation, but it's now in the code. And it's typical of American legislation that they almost never eliminate anything. They just build towers on top of towers, which is why the code is, 5,000 pages long, right?
Okay.
Okay, thank you.
And the second question?
Second question from Riccardo Cattaneo.
Yeah, can you hear me?
Yes. No.
Okay, thank you for this opportunity. Hi to everyone. I would like to ask Professor Aviona, how do you think? What do you think about the increasement of the threshold for amount A in Pillar 1? Because the first document of the OECD blueprint on Pillar 1 said that the threshold will be I think 750 million, and then the threshold is higher, is 20 billion. So do you think that this increasement is something that derives from a trade-off between the US and Europe? Thank you.
For sure. I mean, I think this whole, so for one thing, remember the original OECD proposal of Pillar 1 was only, potentially digital businesses and consumer-facing businesses and so on. So it was written in such a way that it only hit the Americans, which is exactly what the Americans objected to, that it was discriminatory according to everybody in the US. So the political agreement between the Biden administration and the Europeans in this context was to do what they called comprehensive scoping, that is to write the rules in such a way that it will only depend on size and not on type of business. And so they eliminated all the type of business stuff. And because of that, it's likely, as I mentioned, to hit some European companies too. And the ones that as I said, I mean, the one that I always hear about is Siemens, because apparently they sell enough stuff directly into the United States to be subject to amount A in the US. And there may be other ones. Spotify comes to mind as a possibility. I just don't know what their profit levels are and all the rest of it. But still, I imagine that the majority of the companies that will be hit by amount A are the Americans. But at least it gives you some face saving. That you don't say that this is deliberately discriminatory in such a way. And what was interesting is that this agreement was negotiated, I think, by Ty Greenberg from the Treasury, who was the main proponent of hitting the Europeans with various penalties if they discriminate. So essentially, the administration position, at least, is that this is not discriminatory anymore.
Are there, gentlemen, any further questions?
Thank you so much for your answer.
If not, thank you very much, Reuven. You can stay with us. Now we get a bit more European, or you can leave. But I think we are 5 minutes ahead of schedule, and you do as you wish.
Thanks. Take care. Bye-bye.
Thank you. Now, the second speaker today, and I proceed here as outlined in the program, will be Marco Greggi, and he will obviously reflect a little bit on what Reuven has said as far as the United States is concerned, and we'll put that a little bit in the context of the OECD. And to introduce the speaker who doesn't know him, Marco Greggi is an eminent and well-known professor of law and professor of tax law at the University of Ferrara. I have a son-in-law who comes from Ferrara, and I know that the Ferraresi are extremely proud persons and also very capable in matters of international taxation. And I think you are a professor of law there since considerable time. And also what is important to add here, you are un consulente dell'ufficio del massimario. That means the advisor to the tax court of appeals, which I understand in Italy is rather a high-ranking function. And then what I see that once in a while, this is back in 2015, you were a visiting lecturer at the SUPSI, but only for a very short time. And I think as this technical equipment evolves every year, and we now have the possibility to streamline and do these video conferences, I think you should get more actively involved with the SUPSI now that we are back in shape. Thank you. The floor is yours.
Thank you very much, Peter. Actually, indeed, yeah, there is some sort of cross-fertilization between the University of Ferrara and the SUPSI. We really been working together, and well, I'm really looking forward to work again in the future. And as for now, well, it's not easy at all to take the floor after Professor Aviona's presentation, and no easy in any way. And plus, I was tasked by, I think, well, the scientific coordinator to do something that I've never done before, technically to bridge a gap or to bridge an ocean between the United States and the European Union, and to see how the latest proposal by the American administration, by the Biden administration, would fit into the well-established tradition of the pillars, of the OECD pillars. And I say tradition because we have been talking about these pillars, this project for years now. We started some years ago. There's been a huge debate at the academic level. Well, of course, practitioners were engaged for a very long time because, well, you know the story better than I do, because of the impact of these possible changes on the everyday practice, on the everyday life of multinational, and therefore of the advisors. However, Ruben Aviona said that actually we are probably looking at the same thing, a more efficient, robust international tax system, perhaps a new international tax order. We are looking at the same thing, well, together simultaneously, but we are taking it from different perspectives. We have different visions of that. And this is the reason why, now here comes the hardest part of every online presentation. Try and share the PowerPoint. And this is the reason why I hope you can see it.
Yes, we can see it. That's fantastic.
Terrific. The first
if I can log in as you did, I'm perfectly proud of it, but I think I'll miss that one. But go ahead, please.
It's the first time in my life that it works at the first shot. So technically, I reshaped a little the title of my presentation, well, which was supposed to be the US proposal and the pillar-based approach. So United States on one side, European Union on the other, and another view of the cathedral. Well, those of you who are more engaged in the theoretical research, in academic research, and well, Professor Aviona, of course, they remember that this field of research brought to my mind one of the most important influential paper that were ever written, I think, in the recent history of the American law doctrine, which was the paper co-authored by Professor Guido Calabresi and Mr. Melamed in 1972. And those two prominent American academics, they, as a matter of fact, they rewritten most of the American research on the protection of the environment, and in their research they made property rules and liability rules working together in order to protect the environment under the American law. And they titled their masterpiece on the Harvard Law Review, published in the Harvard Law Review in 1972, One View of the Cathedral. And why is that? Because they were thinking about a painting by Claude Monet, actually a series of paintings of Claude Monet at the end of the 19th century. And that Claude Monet paintings are famous because the painter represented the very same subject so the Rouen Cathedral, but in different moment of the day and from, well, partially different perspectives. So the idea of Calabresi and Malamud, those two prominent American academics, was to stress the fact that perspective is important, but still we should not forget that we are looking in the same direction and looking at the same thing. So essentially, we are time sensitive this afternoon, and I have around 40 minutes to make my presentation. Here you have a very quick outline of the points that I would really love to address with you from this moment onwards, essentially. A quick follow-up to Professor Aviona's presentation on the US proposal, as I got it with the eyes and with the glasses of a European, the state of the art of the OECD in this respect, of the OECD work. What are they been working about, or have been working for in the latest years? And the scenario that we are experiencing in the old continent. Nicola Sartori, after me, will address the digital service tax. A lot has been done about that. A lot of changes still in the pipeline. So the works are still in progress, even in Europe. And eventually, well, you know that in this Friday, we will have a crucial moment in the development of these policies at the G20 meeting in Italy. That will be a conference and a meeting, an event chaired by Italians, by Italy, which is leading now the work. And probably we will try and see what the probable outcome will be in this respect. Oops, I'm sorry. Yeah, the common ground in this respect. And mind you, if I am to follow the Calabresi Malamud perspective on the topic that I'm supposed to address, I prefer to begin with what we have in common, rather than stressing differences between the American administration, the former, the current, and the European priorities, and the OECD position. Well, I still believe, and I'm still convinced that we have a lot in common on these issues. The first, the gentle shift of the focus of international taxation on the source state. And this was very clear. This was very clear in my view from the last slide that Professor Aviona shared with us on Pillar 1. There is an interest by several states to focus a little more, to attribute a little more of a taxing power to the source state. But I will be clear on this point later on. And therefore, in this respect, for what concerns United States, this will mean multinational enterprise to pay a little more in foreign countries where they do business, but also the other way around. So foreign multinational enterprises to pay more in the US. Professor Aviona mentioned Siemens multinational. We could also mention the SAP, which is a software development multinational. You if you are an accountant, or if you work in the business, you know SAP very well. And he also mentioned Spotify, and of course we should not forget in the next future that we will have to deal with the Chinese multinationals which are active in this sector. So on one side we have Tencent Technologies from Shenzhen, and then we have ByteDance, which operates the famous, I don't know how to call it, social network TikTok, which is tremendously popular amongst the teenagers. So the consumers of the future now, Facebook apparently is for people our age, not for young people. And of course, well, the United States innovation in this respect, the proposal, the Biden bold proposal, the Yellen bold proposal for a minimum tax should, in theory, crowd out investments in low tax jurisdiction. As an academic, of course, I'm not in the practice, so I haven't got the sensitivity to this topic that most of you have. Well, my first concern is to understand whether we are witnessing the rise of a new international tax system or a new tax order in many respects, like more or less what happened in the 70s or even earlier. Well, these are new rules, indeed. as Professor Aviona pointed out, a lot of things are in the pipeline. A lot of changes are proposed, suggested, debated, disputed on both sides of the Atlantic Ocean. Some of them eventually will come to law, others will perish. These are the rules of the game. But indeed, there are still qualitative and quantitative limitations, which are, for us, for me as an academic, remarkable in this respect. Qualitative limitations, well, we see that in most of these proposals hanging up in the air, we have exclusions carved out for oil, gas, and extraction industries and financial services. If I were in the shoes of a Swiss businessman, of a Swiss policymaker, I would insist also for pharmaceuticals, considering that Switzerland is very strong on this point, and because of COVID, I think that in the medium and the long run, we should also, well, put under the spotlight the pharmaceutical industries in a tax perspective. And of course, we have also quantitative limitation, but this is something that Professor Aviona has already been talking about. In particular, the pillars-based approach by the OECD, but the Biden proposal is not that different in this respect, provides for specific thresholds in order for the new rules for being enforced and applicable. During the discussion, during the questions that I heard a couple of minutes ago, and during Professor Aviona's presentation, well, our attention was focused on multinational enterprises in general, and of course, multinationals which are active in the digital sectors, of course, because they are, well, under the spotlight these days, which makes perfectly sense in a practical perspective, because first of all, we are practical persons. But if we have to look at international tax law the way we love, I mean, as a system, we should also remember that the rules that we are drafting, if we are planning to rewrite part of the international tax system, we should also take into account all the other enterprises, all the other businesses, all the other entrepreneurs that for one way and the other do not fall into the hypothesis that we have listed so far. So my concern is that we are actually dividing international taxation into two tiers, one tier applicable only to the players with rules dedicated to them, and the second tier for all the other taxpayers with other rules which are applicable to them. And this sort of discrimination, I think, is not entirely consistent with our culture, with our tradition. The preliminary finding in this respect, here's the first conclusion. Tax empowered attribution, and this is our point, is changed for specific cases. The big multinational, Google, Amazon, Facebook, those falling into the boxes provided by the pillars-based approach and the Biden's proposal, while the overall pictures for all the others cases still remain the same. So is the point, again, going back to Calabresi and Melman, to their masterpiece, which written in the early 70s. We are looking at the same cathedral. We are looking at the same pictures. We are looking at the more efficient, just, perhaps even inclusive international tax system, but from different perspectives. So that's the reason why probably what we see is not what the others are looking at, but the thing is exactly the same. First of all, still we are talking about taxpayer residence, which is central to the discussion in the OECD doctrine. Then again, we are still talking about the allegiance of the taxpayer, which to a system or to another, to be assessed through personal benchmark, well, with some connection. So at the end of the day, well, the presentation of Professor Aviona and the debate that we have later on are both the presentation and debate still focusing on or dedicated to who is supposed to tax what and according to which criteria. So residence plays a pivotal role in this respect, but perhaps we could derogate if some conditions are met. But still, in this point, this is my view, we are talking about derogation, exceptional rules, variation or deviations from the standard in international tax law. The standard remain unaffected. And of course, we have to deal with the fracture within the OECD. Well, quite obviously these days, if you look at newspapers, if you go on the internet, if you attend other events like this, we look at articles, we listen to people that emphasize the separation, like the split, the difference, the delta between Americans and Europeans, because we have different agendas in many respects, apparently. But as I told you, we should not underestimate the fact that in the next future, I believe tomorrow, the day after tomorrow, other players will come into play. Other players will be engaged in this debate. It could be the Chinese in the next future, perhaps the Indian in the long run. But if you look at the software industry, the coding facilities, the concentration of engineers and the like, we all know that I'm missing the word in English, but the Schwerpunkt in German, so the most important point is shifting towards the east. So they should be engaged in this debate as well. The new scenario which is unfolding is a scenario that actually witnesses three items, three pieces of a unique mosaic. We have to consider together and understand how the current American system based on guilty and beat could coexist with the new proposed system, the Biden minimum tax, together with the Pillars 1 and 2 strategy, and this is a point that we have underestimated perhaps so far, and the unilateral solutions, which have already been put into practice. Right after me, Nicola Sartori will spend time in discussing the Italian digital service tax, how it was conceived, how it developed, and I fear how is it going to die. But this is up to Nicola. But one point is certain in this respect, and the certain point is that the digital service tax is there. It's been approved by the Italian parliament. And together with the Italian, we have the French, we have, the Turkish maybe, and we have several taxes which are already applicable, which are already on the table. So the job for the policymakers, politicians, negotiator is tremendously complicated, as they have to make sense and to coordinate four pieces together and in a way simultaneously. The U.S. situation, and as we see it from here, what did I learn from Professor Aviona's presentation and from the PowerPoint and the materials? I think that I learned a lot from him. Of course, it's always like that. We share the same concerns, indeed, with the American, but we have different ways and means to address these concerns. We've been working on the base erosion, profit shifting. The United States, and particularly in the past, and with the former administration, they work unilaterally with measures. Professor Aviona have been talking to us about aimed at clawing back wealth and revenue allocated abroad and kept abroad. The very last question raised during the debate was tremendously important in my view, when they asked it as on whether subpart F, the CFC regulation, would still be applicable because of guilty, and Professor Aviona said, well, probably they are overlapping each other in a number of situations, not in all of them, but in a number of situations they do overlap, where guilty is indeed supposed to attract something more, to claw back, efficiently or not, with success or not, for good or bad. That was the policy goal that the former American administration seek to achieve, or in a way to make America tax again in a number of situations. In Europe, what is our view in this respect? In Europe, I believe that most of our proposals on this ground were essentially built on a way of thinking in Latin forma mentis of the policymakers and the academics and practitioners, which is in many respects VAT inspired. So we look at the place where the transaction occurs, the service is delivered, the client exists, and the ongoing debate on the Pillar 1 and on the digital service tax is a debate which has been ignited from this sort of VAT contamination of the whole thing. And therefore, and also because of this, are we in some sort of collision route in this respect? Well, indeed, all the stakeholders on both sides of the oceans, and even the Chinese, I think, agree on this. And even the Chinese agree on the necessity to tackle and to address base erosion and profit shifting. So we share the goal, we share the vision. We do not share the means to be adopted in order to achieve that goal. The Americans prefer, well, to overhaul the system. They are a bit more conservative about this respect in a global scenario. Europeans are a bit more brave in this respect. Most of the changes, most of the proposal ignited by the OECD actually comes from Europe. And this makes perfect sense because from a philosophical point of view, we are a little more Westphalian in this respect. So we tend to regulate things according to the interest as they are in our territory. The Americans are, I believe, this is my view, very different from us because they have a much broader view than the European have. And therefore, my vision is that the conflict that we are experiencing in these days, not only a conflict on technicalities, on rates, on percentages, on numbers, on, well, you name them. It's a cultural clash in many respects. And I think the job of the academic is to minimize such a clash. Is this a contradiction in this respect? Who are the winners? Who are the losers? Why the Americans are at the end of the day changed their view and started suggesting this minimum taxation, these new clawback measure? Why such a dramatic U-turn in their diplomacy from the former tax administration and in their way of dealing with the proposals that were coming from the international world community? I have a very, very personal idea about this. If we look at some data, these are the numbers that I've taken from, well, the United States Census Bureau, which is a branch of the Department of Commerce and validated by the Bureau of Economic Analysis. I didn't build a series in time year after year, but what we see here is the performance in terms of importation and exportation of the American economy in a time frame that goes between 2019 to 2021. So right before the COVID, during the COVID, and in this moment. So what do we see from here? And the other data that I have collected that I didn't put into slides in order not to make it too heavy, confirm this vision. The American economy is characterized by an increasing percentage of goods imported. You see, in the last period under consideration, the deficit increase of plus 4.2%, exports plus 0.5, imports plus 1.4, and you see the graph on the right that confirms the amount of the importing goods. So what does this mean? And what is the connection between these numbers and the topic that I was supposed to address? I believe there is a connection. The American economy is going out of the crisis. Apparently it is, because of the huge deficit spending by the Biden administration, the billions and billions of dollars that have been pumped into the economy in order to grant the recovery as fast as possible. This billions of money pumped in determined, besides inflation, we will see that in a moment, an increase in importation of goods. So more goods imported, more business in the US for foreign multinationals. So there is an inflow of goods and services from abroad. That's the first effect of the boost to the domestic economy. Increase in supply demand, increase in prices, of course, and importation of goods. So what does this mean? It means that now as far as, or because foreign companies are making more profits in the US now than before, more now than before. And why is that? Because they are selling more in the US. The US are importing more than in the past in terms of goods and services. Perhaps it is in the interest of the United States of America as well to fine-tune the tax rules in a way in order to intercept the wealth generated on the territory of the United States of America. So in my view, in my understanding, the Biden proposal is bold, is something that we share, perhaps it's something that we like eventually, but it's also something in the current interest of the United States of America. European scenario and the numbers, my view, this is my impression, the numbers confirmed this vision. The number confirmed that adjusting the power to tax and jurisdiction to tax according to the minimum tax, and somehow the Pillar 2 is in the interest of the United States of America as well. So there are no winners and no losers in this respect. European scenario, I lost the sense of time, but just a few minutes and I'll be over. The European scenario now, well, actually, we have digital taxation proposal and digital tax policy, something that Professor Sartori will deal about. But my view is that the current debate in Europe is shifting towards different topics. Well, the pillars are important. The discussion in Rome will be crucial. A great expectation on the G20 meeting and the outcome of it. We have been talking for so long. Now it's time for result in the interest of Europeans and Americans, the OECD, and also for the other. But the spirit of the time in Europe now is concentrated on recovery plan, green taxation, and carbon emission taxation. This will be probably another battlefield in the months and in the years to come with America as well. Environmental taxation, green certificate, emission trading, and much more. So the debate really in the field of international taxation is probably today much more extended, much broader than it was in the past. So yeah, different set of priorities and different things in the pipeline. Unilateral approaches. Yeah, this is the unilateral approach which we have to deal with as the OECD proposal and the American proposal. The only one? No, we have a lot of things implemented unilaterally. We had in the past the British diverted profit tax, which to me was really tremendously fascinating when it was passed around 4 years ago or so, which, well, some sort of revolution, something we had to maybe to consider more. Well, digital tax, Indian equalization levy. Then we had something that, in my view, academics don't speak enough, don't talk enough, the UN variation to their model, Article 12A and B for technical services and automated digital services. So the OECD, of course, is at the center of the scene. It makes sense for a number of reasons, but we should not underestimate, at least under the theoretical point of view, at least we as academics, also the huge efforts the United Nations have dedicated to the international tax order in many respects. And then, of course, there are the Chinese that we didn't consider, that we have not been considering for years. And at the very first moment, they completely disregarded all the OECD works on the pillars 1 and 2 for years. In 2019 and even in 20, they just didn't care about that. They thought that was some kind of Western folklore, something you look at, something you pretend to appreciate, but essentially you don't care. Now in China, I've been told the wind is changing, and they are having more and more events similar to this one. Well, not so efficient, Swiss efficient like this one, but similar to this one, of course, on the pretty much the very same topic, because even the Chinese are now realizing that the rules that we are about to carve on stone, which being rules that will be applicable to their game in the next future. They have been focusing on a different way of understanding international relation. They have the One Belt and One Road project, which has also a tax wing attached to it. But of course, well, today is not time for that. And yes, then there is us. This was something that I had prepared only for Professor Avion. I'm sorry that he left, but maybe he will have the opportunity to watch and listen to the video recording of the session. Then it's us, the China approach ourselves. I mean, the dust on the boot of history. Italy, unfortunately, is pretty much like this, as Hegel would say in many respects. And the Italian approach to base erosion and profit shifting. Now we have been living with these new challenges so far. There is a case this was not a case, but there was a situation occurred 2 years ago that is a clear indicator of how Italy sometimes treats scenarios like this. I mean, scenarios where the apportionment of taxing power is not efficient, is not neutral, is not consistent with the expectation of the state. And in the Netflix case, this is something that happened at the end of 2019, well, in October. So you see, 2 years ago. And at that time, look, please, at the day, October the 3rd, 2019, and the time when this Bloomberg was shared. And this was an article where Bloomberg pointed out that investigation was about to be launched on Netflix for failing to file a tax return in Italy. The understanding of the Italian Revenue Service was that Netflix has some sort of permanent establishment in our country, and they failed to prepare a tax return. So that is where the investigation started. And you see the day and the time. Then Bloomberg, right after that, shared the view. Well, Netflix is going to make is going to invest in Italy and in a number of projects in order to formalize its presence in the country. And the day and the moment of the press release is significant, still the very same source, Bloomberg. Then we had, this is in Italian, but I think that most of the audience is Italian, but I also prepared the translation in English. A few days after, on October the 8th, so the inspection was made public on October the 3rd. 5 days after, Sole 24 Ore, Netflix is announcing a new seat in Italy, legal seat in Italy, in alliance with the local business Analyze in order to produce film, to have a permanent establishment or a subsidiary under the light of the sun. And they disclosed the number of people that were subscribers to Netflix. 2 years ago, there were 2 million. Now, apparently, the number of subscribers climbed up to 4 million, probably because of the COVID. And at the end of the day, this year, September the 8th, 2021, they confirmed the interest in having a subsidiary here, started paying taxes, and do what they are supposed to do in our country. So this is the Italian way right now to deal with the challenges posed by the digital economy, the multinational, the internet, and the like. Good or not, I don't know, but for sure we cut a number of corners, and at the end of the day, we brought home the result. Conclusion for this: after we compare the American perspective, the European, and the Italian, I'm more and more convinced that following Calabresi and Melamed, indeed we are looking at the same cathedral, however, from different perspective. And I think that events like this, and I'm very grateful to Supsi, to Dr. Altenburger, to Samuele Volpe, and all his team, are tremendously important, as crucial in building a reciprocal understanding and looking at the same thing from the same way. Thank you so much. And that's it.
Thank you. Grazie Marco per l'interessante relazione.
Thank you. Thank you very much, Marco, for this excellent presentation. And really here, my question goes a little bit in the direction that you have mentioned several times, that here we forgot about China, and China will become an important player. And yet somehow we are still playing according to US rules. And maybe this is totally, if I may sum up, something which is European-like, not so much anymore, because really here Europeans have different interests and different stakes, and we are unfolding a broader spectrum than what we had in the past. And really my question here is a little the same than I had to Ruben. I think you think that we can live or that we can go without this Pillar 1 legislation, which to my mind becomes utterly complicated. And as I said before, in Switzerland, we have no clue how we will go about implementing this Pillar 1. And Pillar 2 is obviously much easier there. You don't have to amend any treaties, nothing. You just have to amend a bit the rates. And here you're there with Pillar 2. And what is your opinion on this one?
Well, Peter, first of all, compliant with the full disclosure, I've never been involved in the negotiation, of course, so I have no insider trading. But looking at the whole thing from outside, from layman, from the man on the street, the idea that I had from the very beginning was that Pillar 1 was some sort of how to call it, some sort of a bait, something like in Italian, a bait, something that put on the table to ignite the discussion, to start the debate between states. But at the end of the day, the goal was another. But to bring home the result on maybe on Pillars 2, like Professor Aviona pointed out, which is feasible, which is reasonable, which is working. Pillar 1 is, if you read it from the very, in fact, the very first draft of it was proposed by the Secretariat of the OECD, so it was some sort of internal paper by the OECD. But I think at the very beginning, they launched it in order to to make it loud, to draw the attention to people and to start a discussion. Harsh reaction by the Americans. No way, never ever. This is really a bridge too far, like the Brits would say. So in order to bring home the result, which is another one, maybe the OECD is ready to surrender it or part of it for the final outcome. But I'm not inside. I'm not an insider. So my impression was this. In your theory, I mean, from a descriptive point of view, it makes sense. It's fantastic. You split your income into two parts, A and B, then you apportion it accordingly to whatever. I mean, on books, it works perfectly. But I think that in action, Peter, you know the story better than I do. It would be tremendously hard for practitioners and multinational to live without. The level of uncertainty that a decision like those, apportionment like that one, bring to the system is, I believe, unbearable for the real business. So that is essentially my
because I'll then come back on my own slides and to anticipate here what I have found is that somewhere in this global minimum tax approach, that's the only one which I will address, there is a sentence which establishes a guilty coexistence where consideration will be given to the conditions under which the US guilty regime will coexist with the GloBE rules in order to achieve a level playing field, which to my mind means clearly that as far as the OECD is concerned, here we are still somehow implementing or help to implement US rules, and all the rest really is nothing which is of anybody's concern for the time being. But I think you're absolutely right. I think we have to be much broader. We have to look at China and Brazil and many other countries in order to find a common denominator. And here, as I pointed out before, and as you all said, that Pillar 1 was sort of a instrument to get on the horse. But once you're up there, you may as well then sort of forget about this whole thing. and concentrate on pillar 2, which to my mind is a success story in its own, but I'll then reflect from a Swiss point of view.
Yeah, I know, Peter. I have no expertise as a negotiator, of course, but from the very beginning, I had this impression that many things were put on the table by the OECD just in order to trigger reaction, to see the reaction of the others. Well, no, absolutely no, and maybe, perhaps. And once all the reactions were collected, then they went further on, moved a step forward. And this is also the reason why I think that, in my view, it's essential to engage in the debate also the players of the future, like the countries in the East that, in terms of digital economy, will play, I believe, a remarkable role, like Taiwan, as Professor Aviona pointed out, China, and all the others, because, well, they will have to play with these rules. So it's better to get their consensus in advance rather than issues late after. This is my impression.
Nicola, do you have any views to offer here?
We have a question from Simonetta Zubani.
Okay.
Can you hear me?
Yes.
Loud and clear.
Okay. So first of all, I would like to thank you all for giving us this very important opportunity and interesting opportunity. And I would like to thank Professor Gregi for his very clear explanation of the European and American scenery. And coming back to the European scenery, I would like to ask you to an explanation about the itemized approach, because I didn't know this word. I only know the word customized approach, and I don't understand if itemized would be the contrary of customized, or it has nothing to do with.
Well, probably that was, yeah, Ms. Zwani. Thank you very much for the feedback. I probably my presentation was not clear enough. Itemized, I mean, it comes from item, from a specific piece, could be piece of income, piece of capital, or the like. So an approach following to that is an approach like tailor-made for one asset, for one kind of income, for one situation, and which is not replicable to other. That was my view. Some sort of tailor-made. My concern is in that respect, but this is again a problem that I have. Because of my limited background as an academic, I don't feel comfortable each time we create special rules addressing special situations and special scenarios. These provisions are applicable to that kind of multinational. This regulation makes reference to that business and not to the other, to this threshold of income. That's my view, is disturbing. And I think also, I don't know your background, if you are from academia, from the practice, even for practitioners, I think it's a problem to live with this hypertrophic system of regulation. But that's it.
Oh, well, I find also, well, I thank you for your answer. I also find very interesting your so-called environmental taxation, green taxation, and carbon emission taxation, because it's a very important issue nowadays. Also thinking about the Greta Thunberg movement and the sensibility of the human being, I hope, after COVID pandemic. And this would be very interesting for me, for my opinion, to underline the importance of this kind of taxes if they will really be the future.
That's the problem. I just mentioned that very briefly in my presentation, because actually that's not a topic that we're supposed to address today. But there was a reason for that. Because if you look at and Peter and Nicola may confirm this, if you look at the current discussion on the Italian newspapers, if you open the Sole 24 Ore these days, of course you find articles on the minimum tax, the Biden proposal, and the like, which is under the spotlight. Of course, Mr. Zubani, it's there. But you find more articles on green taxation, green economy, special taxing rules, how to collect taxes from the carbon emission and the like. If you number the articles, green taxation is under the spotlight. So it appeared to me that now the European attention, right or wrong, good or bad, choices, your vision is yours, is a little more concentrated on this aspect. We have the PNRR in full swing now in Italy, and they say, well, the resources to pay back the plan will be taken from, et cetera, et cetera, et cetera. I'm not making any judgment, for God's sake. I'm not making it, but that is apparently priority number one in my country. Well, personally, I agree with that. That's personal.
Me too.
It appears that was a very good question.
Yeah.
Okay, thank you so much.
Thank you.
Are there any more questions? Otherwise, and with a look on my watch here, we are exactly on schedule. And I would like to thank Marco Greggi very much for this excellent topic. And I think he really looked into the future, and he looked quite a bit beyond OECD. And unfortunately, I would like to say here for the time being and for this particular conference, we are stuck with what OECD has said, and we cannot go any further. But I'm sure that, next year, a year from now, we'll obviously speak more about your topics. And I would now like to pass the floor to Nicola.
That's a promise, Peter. This is a promise, so Sasha can take note of it.
Yes,
I do.
And I would like to pass the floor to Nicola Sartori. And Nicola, he has one big advantage to you. He lives closer to Manno, and he lives closer to Supsi. And, once in a while, he can take his car and go from Milano to Manno, and he is a visiting professor at Supsi, and he does that very artfully. And I think he is one of the leading Italian figures Supsi has in its program. And apart from that, he is obviously a full-time professor of tax law at the University of Milano Bicocca, and he does that with great success and since considerable time. And I would like to pass the floor to Nicola.
Thank you. Just let me share the slides. Okay, can you confirm that you see the slide?
Yes.
Okay, wonderful. So it's not easy to speak after Professor Aviona and Professor Marco Greggi, but I'll do my best. I'll do my best to discuss and to talk about the digital service tax and the Italian perspective, and a little bit about the EU perspective as well. So let me make a step back. So what we are talking about today is basically the tax challenges raised by the digitalization of the economy, which is a priority, as we know, both for the OECD and the EU, and also for many countries like Italy. The basic international tax problem is still the one that was raised in 1923. So again, here we are looking at the same cathedral, but in different times. what is the issue? The issue is the amount of taxes on cross-border income and what countries have a better right to tax. What is the difference between now and 100 years ago? The source of wealth. 100 years ago, the source of wealth was the land. As you remember, the 4 experts of the League of Nations made clear in the famous report of 1923. Now, what is the main source of wealth? The main source are digital data and information. And as a consequence, 100 years ago, the economy was mainly physical, while now it is digital. However, the solution suggested by the 4 experts in 1923 is very similar to the one suggested now. So 1 year ago, as now, the solutions, as you can read it in the slide, were to tax cross-border income only once, the single tax principle that Professor Aviona teaches us, and also to apportion taxing rights among countries based on the relative interests of each. So the issue is which countries have this interest or nexus or link. In the current international tax regime, the link, right, the nexus has been designed based on a physical world and not based on a digital world. Corporations basically end up paying income taxes where productions occurs, where there is a permanent establishment, and not where consumers are, that in digital economy are known as users. Because of the absence of a physical presence, corporations are generally not subject to income tax in the country where users are. So the main problem is that the current international tax regime does not take into account the main source of wealth of digital economy, which is the use of personal digital data. The country where most of the value is created, which is again the country where the users are located, might not be the country of residence nor the country of source. And in many cases, it's neither the country, the market jurisdiction. For example, think about a US multinational selling personal data of Italian users to a Japanese corporation. Italy does not have any taxing right based on treaty law, assuming there is no permanent establishment in Italy. So I think that the most relevant aspect of the digital economy is the fact that businesses derive income from users located in countries where businesses do not have any physical presence. Well, both at the OECD and at the EU level, it is agreed that countries must find a common solution to this problem. Basically, everyone agrees that a common solution is preferable over an individual solution. So this is the point. And I will read it. The question of international tax evasion can only be solved in a satisfactory manner if the international agreements on this matter are adhered by most of the states, and if they are concluded simultaneously. But this again was written 100 years ago in one of the League of Nations report in 1925, and it is exactly the same that we are saying now. So, in order, to solve this, don't worry, I'm not going to talk about so much Pillar 1 and 2. But in order to solve this main issue, Pillar 1 aims to do what? To ensure a fairer distribution of profits and taxing rights among countries, and to reallocate taxing rights to market jurisdictions. So to jurisdictions where the customers and, I would add, users of multinationals are located. Moreover, under Pillar 1, unilateral measures, and that's why Professor Gregi was saying that the digital service tax is going to die. It is true, because unilateral measures that have been adopted in the meanwhile should be eliminated. Pillar 2 has the scope, as we know, to increase the total revenue to be reallocated by avoiding basically double non-taxation and providing a minimum tax. At the EU level, we had 2 directive proposals in March 2018, one long-term proposal aiming to reform corporate tax rules so that profits should be taxed where businesses have significant interaction with users through digital channels, and also a short-term directive proposal aiming to introduce an interim digital service tax. And this was there was also a proposal to introduce the new digital service tax as a new EU-owned resource. However, EU member states are also part, of, as we all know, of the OECD inclusive framework. And Commissioner Gentiloni, about 2 weeks ago, October 13, stated that once the OECD has finalized the model rules for Pillar 2, the Commission will swiftly put forward a directive for its implementation in the EU. For Pillar 1, says Gentiloni, we will carefully examine whether a directive is needed to ensure its consistent and effective implementation at the EU level. So Gentiloni said that what we are expecting is nothing less than a tax revolution. Also, the director for direct taxation of the European Commission, Benjamin Angel, announced that the minimum corporate tax would be implemented at the European Union, at the European level, as quickly as possible. Well, in the meanwhile, certain countries have done some steps forward by adopting unilateral measures. Professor Gregi spoke about this, about some of the solutions already. I will just focus on the Italian one. So among the countries, there is Italy, which adopted a new tax on digital services effective January 1st, 2020. It's very similar to the first short-term EU short-term proposal that, and also it's similar to other unilateral solutions. Before actually adopting the digital service tax, Italy has also changed the domestic definition of permanent establishment. And after this change, a significant economic presence in Italy of a foreign corporation is qualified as a permanent establishment for Italian tax purposes, even in the absence of a physical presence. However, this change would require domestic treaty override to be fully implemented in the international tax regime. But this is not possible because in Italy there is a constitutional bar, Article 117 of the Italian Constitution. Therefore, treaty law prevails over domestic law. So the posterior domestic change of the PE does not have any effects on the treaty law, and the PE definition of treaties prevail over the domestic definition. In general, I would say that, and this is one big problem, that most of the unilateral solutions based on income taxation would be prevented by treaty law. So for this reason, Italy adopted a totally different unilateral solution, the digital service tax, that is not prevented by treaty law because it is not an income tax. The idea of this tax is to overcome the current problems of the taxation of digital economy in the short run, of course, in the short term, without incurring in treaty override. And this tax is intended to make sure that corporations, big multinationals, at least pay something in the country where users are located. So let me now briefly describe the structure, very briefly, of the Italian digital service tax to see how it fits in the international tax regime and how things will change as soon as a multilateral agreement on Pillar 1 is reached. First, who are the taxpayers? Anyone carrying out a business activity, a person or an entity. This tax is theoretically applicable to both resident taxpayers and non-resident taxpayers, even if they do not have a permanent establishment in Italy. The tax-paying unit, however, is not the group, but it is the single company rendering digital services in Italy, or theoretically a single individual. Of course, this is not going to be the case. The taxpayer, individually or at the group level, must be a big operator of the digital economy by meeting in the previous calendar year both the thresholds that you see in the slide, so total amount of revenue exceeding 700 million euros and an amount of revenue from qualified digital services arising in Italy equal or exceeding 5.5 million euros. These thresholds do not make the tax progressive. The idea of the thresholds is to tax only big players of the digital economy able to engage in aggressive international tax planning strategies, and that can really increase their value using personal digital data of users that are located in Italy. Considering that the digital market is a market where the winner takes it all strategy exists, I would say that this tax has also a regulatory component. Basically, the DST helps small players to get into this market dominated by a few big players. And moreover, by taxing only big players, the DST does not discourage businesses in the digitalization process, which is a fundamental process. What are the facts that trigger the tax? The tax is triggered if taxpayers provide qualified digital services in Italy. And there are three types of digital services in Italy. Advertising on a digital interface targeted to users on the same interface. For example, think about the targeted advertising you receive when using Facebook. I bought a tennis racket about a week ago online, and I keep receiving advertising about tennis rackets. Someone needs to tell Google that I already bought the tennis racket. I don't need it anymore. I don't need two rackets, but I keep receiving advertising about that. Then we have provision of digital multilateral interface aimed at allowing users to interact, or also to facilitate the direct exchange of goods or services. Let's think about eBay that facilitates users to exchange goods or services in a tailor-made. And finally, the sale of data, of digital data. So here we really see how users are factors of production. Moreover, there are other digital services that are specifically excluded. I'm not going to go through them, but you can see them in the slide. And that are excluded because the idea is to consider only the digital services in which users can be considered factors of production and not just customers. Quantification of the tax. The tax is determined with a flat rate of 3%, applied to a taxable base equal to the turnover related to the Italian digital services with some specifications. For example, intercompany revenue is not taxable. Costs, by definition, it's not an income tax, so are not deductible. Indirect taxes like VAT are deductible. And also the revenue is determined based, is not determined based on the cash method. Just a couple of words about the territoriality rule, and then I will move to some general considerations about how this digital service tax fits within the international tax regime. In order for the tax to apply, the users must be located in Italy. And IP or other geolocational tools clarify if users are located in Italy. So if, again, we think about a US company, okay, selling personal data of users located in Italy to a Japanese company, the DST will be applicable to the non-resident taxpayers, the US company, even if it doesn't have a permanent establishment in Italy. And it applies with regards to transactions and transfer of money between two foreign persons. The Japanese company will pay the US company. And also, it might be applicable with regards to users that are not Italian. Think about a Swiss person traveling in Italy when the data are taken, and when they are in a Rome airport, they are using the mobile, and some big multinational is taking the data, the personal data. So based on all of this, What type of tax is the digital service tax, and how does it fit with international tax regime? I would start saying, and this is, I think, pretty clear, that the DST is not an income tax. And this is true, first, because the fact that triggers the tax is not income. And second, because also a company with current losses might find itself to pay the digital service tax. So even if the rationale of this tax is to make sure that big corporations pay something in the country where the users are, this does not make the digital service tax an income tax. The rationale of the tax does not change the nature of the tax. So what is it? It seems like, I don't know actually, but it seems like a multiform tax, depending on, on the perspective you look at it. It seems like an excise tax or an advertisement tax or a turnover tax because the taxable base is equal to the turnover. I think in order to identify the nature of the tax, we should probably look at the indicator of the ability to pay. So we need to identify the specific economic force that distinguishes the taxpayers of this tax. And this economic indicator is the acquisition and use of personal data of users. Through this information, corporations can render specific advertisements, can facilitate the conclusion of exchanges of goods and services, and can just make money out of the sale of this information. So I would qualify the DST as an indirect tax on the use of personal data of the users, which are fundamental elements in the creation of a value process. So let me now reach some conclusions about the compatibility of the DST with the international tax regime, and also, if we have time, with the EU law. As we have seen, the DST closes a gap, the lack of taxing rights in the country where the users are located. And the Italian digital service tax allows Italy to tax multinationals on the use of personal data of users located in Italy, as we said, without violating treaties, tax treaties. And current income taxes do not allow this. Moreover, and it is worth to note that users and their locations are not under control of the multinationals. So they cannot avoid the payment of this tax by changing, the location of users. Does this tax create a double taxation? We need to ask this question because the digital tax is applicable regardless of the application of other taxes. So we might have a case where a foreign corporation has a permanent establishment in Italy and ends up paying both income tax and digital tax on the same digital services. I would say that there is no double tax for two reasons. First, the income tax and the digital tax are two different taxes. Second, the potential double taxation is eliminated by the rule that allows the deduction of indirect taxes from the taxable income, Article 99 of TUIR. Moreover, the DST, as we have seen, falls outside the scope of tax treaties signed by Italy because it is an indirect tax, not similar to an income tax. This means that non-resident taxpayers would not get treaty benefits with regard to this tax, and the tax applies regardless of what tax treaties say. Finally, and we spoke about this with Professor Aviona already, non-resident taxpayers are probably not going to get a foreign income tax credit in their residence country. And this, again, because DST is not an income tax. Based, for example, on current US rules, I don't know what's going to happen in the future, but based on current US rules, my understanding is the DST will not be credited because it is an indirect tax, and also because it does not allow any deduction of costs. So it doesn't meet the so-called net income requirement under the foreign tax credit rule in the US. We also have some issues related to EU law. First, the compatibility between with VAT. Article 401 of the VAT value-added tax directive, or as Americans say, VAT, provides that member states can introduce any taxes, duties, or charges which cannot be characterized as turnover taxes. But based on the Court of Justice case law, for example, the Vodafone case of March 2020, DST is incompatible with that because it does not have at least 2 of the 4 basic characteristics of VAT. It does not generally apply to all transactions related to goods or services because it is applicable only with regard to certain qualified digital services. And it is not charged at each stage of the production and distribution process. Therefore, I think the DST cannot be considered a turnover tax incompatible with VAT. Second, we need to ask ourselves if the DST is compatible with the fundamental freedoms, considering that, based on the thresholds, foreigners will most likely end up paying the tax. Here, the Court of Justice said on one side that for a criterion of differentiation that is apparently objective, but that disadvantages in most cases, given its features, companies that have their seat in other member states constitutes indirect discrimination, which is prohibited. So on this part, it would seem to the Court of Justice to say that it is incompatible. But the court also decided that the fact that the greater part of a tax is borne by foreigners cannot by itself be considered a discrimination. The situation might be due to the fact that a specific market is dominated by certain players who achieve the highest turnover in the market. And this seemed to be the case. So I would conclude that the DST does not violate the fundamental freedoms unless it is possible to prove that the thresholds have been set on purpose in such a way to systematically exclude domestic companies from the scope of the tax and to include EU companies, but this is not the case because the thresholds has been set based on the draft of the directive, so definitely not for that reason. Finally, and strictly connected, if Italian taxpayers systematically do not pay the tax because they do not meet the thresholds, we could see this sort of tax exemption as a state aid. However, this tax, including the threshold, I don't think is a danger for the internal market. The tax, as I said before, I think has a regulatory component that helps competition between companies. And this conclusion is supported again by the Court of Justice with 2 recent decisions of March 2021, based on the Hungarian tax on advertisement and the similar Polish tax, where the Court of Justice said that there is no violation of state aid rules. Well, a couple of more issues just before I reach my final conclusion. The first issue is related to the enforceability of this tax. And I think this is strictly connected with what Marco Greggi was saying before. I do not see how Italy practically could enforce this tax based on current territoriality rules. The typical mechanisms adopted by source country to tax the income do not work here because the income does not have its source necessarily in Italy. The so-called first bite of the apple rule cannot be applied. So let's think again for the third time to the example of a US corporation selling data of a user located in Italy to a Japanese corporation. There is no income in Italy, and the US corporation does not have any connection with Italy but for the users. So the transfer of resources is from Japan to the United States. So how can Italy enforce a DST in this case? So if you really want to enforce this tax, we need to, I think, like what Marco Greggi told us about, so to structure penalties in a way to make sure that companies in the end will end up paying the right amount of taxes. The second issue, the second last issue is the fact that the office of the United States Trade Representative within a Section 301 investigation concluded at the beginning of this year that the Italian digital service tax, by its structure and operation, discriminates against US digital companies. This was done for trade law purposes. Well, I personally believe that there is no discrimination here. First, there is no juridical discrimination because taxpayers can be both resident and non-residents. But I don't also see a de facto discrimination because the fact that, which is true, the fact that 60% of the taxpayers of the Italian digital service tax are US corporations, I think it's just a consequence of the dominant presence in the digital market of US players. The European Parliament, in a resolution of the end of April 2021, wrote that EU digital companies that are headquartered in EU member states and are subject to EU corporate taxes are at a disadvantage compared to foreign companies that have no physical presence in any member state and can therefore avoid paying corporate taxes in the EU, even if they operate with European users. So here they talk about corporate income tax. But I think if this is true, the DST, instead of discriminating, again, creates the condition of competition. So, however, this issue does not exist anymore because, as we will see in the next slide, the US agreed to terminate the proposed trade actions and commit not to impose further trade actions against Italy. I will get back to this point in a second. So what's coming next? The DST, Professor Cregi told us already, told us that the end of the story already is going to die. Why? Because it's a temporary tax. Italy agrees with Pillar 1 and 2, and Italy understands that as soon as a common solution is finally in force, Italy will repeal the digital service tax. And this is not only written in Pillar 1, it is also written in the domestic law. In fact, within the DST legislation, there is a sunset clause, Article 49 bis, which says that the DST will be repealed once a common solution will enter into force. The sunset rule, of course, has a political meaning. The idea behind this sunset clause is first to put pressure on other countries to find an agreement, so to find a common solution. Second, not to allow others to criticize the use of a unilateral measure, because such unilateral measures is going to be repealed once a multilateral one is adopted. Third, to clarify that Italy is in favor of a multilateral solution. Moreover, and this is what I was saying already, 5 days ago, October 21st, there was a joint statement from the United States, Austria, France, Italy, Spain, and the United Kingdom regarding a compromise on a transitional approach before Pillar 1 is in effect. They all agree, in line with Pillar 1, that unilateral measures will be withdrawn. But Italy has preferred for withdrawal of the DST not immediately, but to be contingent on the implementation of Pillar 1, as the domestic sunset clause says. In other words, Italy is not required to withdraw the DST immediately, but when Pillar 1 takes effect, and if Pillar 1, I would say, takes effect. On the other side, the US agrees to terminate immediately trade actions proposed and commit not to impose further trade actions during the interim period. However, there is also, it seems complicated, but it's not. Sorry, the slide. There is also an interesting mechanism. I think this is what Professor Aviona spoke about, but I guess we didn't really understand it in the same way, unless he had something else in mind. Because if the DST during the interim period between January 1st, 2022 and Pillar 1 takes effect, that's the interim period, exceeds an amount equivalent to the tax due under Pillar 1 in the first full year of Pillar 1 implementation. So I need to compare the DST paid in 2000 in the interim period, pro rata temporis, with the full amount of due under Pillar 1 in the first full year of implementation. If there is such excess will be creditable against the portion of the corporate income tax liability associated with amount A as computed under Pillar 1. So this is the example made in the statement. So I didn't make it up. I just took it as it is. Let's assume the interim period is between January 1st, 2022, December 31st, 2023. So 2 years. During the interim period, a corporate taxpayer pays 100 in digital service tax in Italy. In 2024, Pillar 1 solution is enacted. Okay, these are the facts. The corporate income tax liability with respect to Pillar 1 is 20 in 2024 and 25 in 2025. Okay, what is the amount of the credit? The amount of the credit is 60. Why? Because it is 20, but pro rata temporis, you need to multiply 20 per 2, by 2. So it would be 40, because we need to compare the first year, which is 1 year of full implementation of Pillar 1, 20, but with 2 years of DST. And so 1 year of Pillar 1, 20, must be multiplied by 2, so makes 40. So 100 minus 40 makes 60. 60 is the excess that will be creditable against the corporate income tax liability. And therefore, the amount creditable in 2024 is 20. So 60 minus 20, the residual credit of 40 can be carried forward. And the amount creditable in 2025 is 25. And the residual 15 is carried forward to 2026. Considering the low Italian revenue collected in the first year of DST application, we were talking about it with Professor Aviona before, it's less than 250 million euros. I guess that this credit mechanism will not actually be applied, because I don't expect to have an excess of DST over the Pillar 1 amount in year 1. Otherwise, this would mean that the revenue collected on amount A, the tax revenue collected on amount A, will be even lower than the DST, which is already very low. Moreover, there might be a distortion. There might be a distortion given by the fact that DST is deductible by taxable income with the cash method. So in the example we made, the DST due for 2023 would be paid in 2024 and deducted under current rules from taxable income in 2024. So in 2024, the new rules should not allow any deduction. Otherwise, the taxpayer would get both a credit and the deduction, assuming I did understand this credit as I did explain it to you, and not differently. Well, I think also, and then I conclude that this credit solution proves that the digital service tax has a very similar rationale than Pillar 1. So this is my conclusion. We basically have seen how many problems a unilateral solution like the Italian one raises. But still, I think this tax, mainly for vertical equity reasons, because of the redistribution that it grants and because it allows some taxation in the country of the users, that are the real source of wealth in digital economy, I think this is not too bad. Also, the current pandemic emergency makes the redistribution concerns even stronger, because big tech companies have increased their profits during the pandemic, while most of the traditional businesses did not. So we need to have some sort of redistribution. Since I started studying tax law, I read papers and proposal, like probably most of us, on how the international tax rules should change, right, in order to take into account the digitalization of the economy. But nothing has been really done so far until last year, until in the last few years. And this is why I like the Italian approach, because at least I think we are doing something. This is a step forward. And this step being unilateral raises a lot of issues. However, if the result of this step is to put pressure on the international community, and the result is that the international community will find a good common solution, I believe this is a great result of the digital service tax. Thank you.
Thank you very much. This was a very good presentation indeed. And just to clarify some of my thoughts, you said, Nicola, that there is a sunset clause for this digital service tax. And according to Article, I think, 49b of this specific law, this sunset sort of triggers in once Pillar 1 has taken effect. Now, may that be that Pillar 1 never takes effect? And what will Italy be doing then? Will then this tax remain in place? And you will say, well, we have linked it to Pillar 1. And because at that time, I think Pillar 2 was unknown when you sort of released the law, and Pillar 2 came up all in a sudden. And now is Pillar 2 all over, and Pillar 1 sort of is Pillar 2 is all over, and Pillar 1 is dropping a little bit of importance. And how do you feel about this famous sunset? Can you make a comment here?
Yes, I think it's contingent to the application of Pillar 1, not to Pillar 2. So if Pillar 1 is not applied, the digital service tax could still be in place. The only thing is that probably the EU, but I don't know what Professor Gregi thinks about it, probably the EU will do something before at that time. Because the EU is just waiting what the OECD is doing. So we might have a common solution at that point. If the OECD doesn't go further with the Pillar 1 solution, maybe what about the tax, a digital service tax at the EU level as a own resource? So go back to the previous proposal of I think was April this year. But I don't know. The only thing I know is that if Pillar 1 is going to be adopted, is going to be enforced, digital service tax will be abolished. If not, we might keep it unless other common solutions are adopted.
Okay.
But maybe Marco knows more about this. I don't know.
Unfortunately, no. But I have one question, if I may jump in the discussion. Well, Nicola, you told that, well, this was your very conclusion at the end of the presentation. So you were somehow positive towards this tax, say, well, it's working, it's achieving this goal, and etc. Well, but a few moments before you said, well, the revenue granted is just 200 million plus. Well, of course, we should not judge the quality of a tax from the revenue. I'll say not, but still, it's somehow surprising that the amount generated from it was not that relevant. Well, I don't know if you had the opportunity maybe to look at some papers or some documentation, but why was that? Do you think it was a problem of design of the tax, or do you think it was a problem of, I don't know, misreporting, or because I think that, I'm not in the business, but I think that the value of the data market in Italy, I mean, data related to digital economy is much higher than that. So,
Marco, I absolutely agree with you. Of course, I didn't expect that. I think it's probably both the thresholds. There are I think 48 corporations paying this tax, something like that. 50 taxpayers. So really, the thresholds probably should be set in a different way. And maybe also misreporting. I mean, that could be possible, that the enforceability problem, that might be the case, but I don't think so. I would see this more like a problem of the thresholds, in my opinion, because I think the expectation, okay, we might think about the expectation. The expectation of this tax in terms of revenue was 700 millions.
Yeah.
From the Italian government, and we got only 200 and a bit more, less than 250. So the difference maybe is kind of a problem of enforceability, but I don't know. And the rest also, I mean, we have to be clear. Also, 700 million is not a lot. Probably in this sense, we have a double problem. I do like this tax because I think it is a step forward in the direction I like, to give some taxing powers to the country where users are located, where the real value of nowadays is, because now it's not the land. I mean, it's still the land, but we also have digital data as a fundamental value that we need to take into account. That of course in 1923 there was no digital world, so they couldn't think about that. So I like the idea of this tax, but maybe, yes, we could think about it better, maybe at the EU level. That would be a wonderful opportunity, I think, for the EU to try with this new tax, with this new EU tax as their own resource of the EU. That could be a great experiment, I think.
Yeah, I share with you, because not for this conference, Peter, but for research of mine, some weeks ago, I did some other research, and I remember that. I think I don't want to make mistakes, but anyway, at the very beginning of the Napoleonic War, 1798, while the UK was in need of revenue in order to deal with this nasty French guy. And they were, running out of ideas. Then the Chancellor, Pitt, came out with this revolutionary idea. He said, well, let's tax income. And the other said, well, it's indecent, never, ever. It will never work. We will never raise revenue with that. But it worked actually. And now we take income taxation as a standard worldwide. So probably this time is not different. We start focusing our attention on a base which appears by now revolutionary, game-changing, unacceptable for the over-conservative, as taxation of income was at the end of the 18th century. But at the end of the day, we're just setting a new standard. That's the idea. And for what concerns the amount, while you were making your presentation, you were sharing the slides and showing out the number, I was thinking about the financial transaction tax that Italy passed years ago. And even there, at the very beginning, there were great expectations on that tax. Well, we are going to raise a lot of money. It's a Tobin tax. We are going to spend the money for this, and that. But also the financial transaction tax didn't perform very well, at least to my understanding. So, it's an ongoing issue, repeating it. That's my
I agree with you, because also, I'm thinking about the U.S. income tax, the first U.S. income tax. I think the first U.S. income tax had a tax rate of like 2% or 3%, something like that. So it was like an experiment, like we are doing now. Maybe
unconstitutional, for God's sake.
50 years from now, digital service tax will be something much more popular. I don't know. I wouldn't expect that, but let's see.
It should have the perspective of historians of taxation.
May I interfere in this academic discussion? And hopefully I can somehow turn in my own slides and continue for the last 30 minutes with some Swiss aspects of the whole thing. I think the audience will then go drastically down. From now we have 29. And while I will be then beginning, we'll have 15, but nevertheless, let's try and let's see if I can share in here. Okay, is that it? Is that it? Host disabled participant screen sharing, what is this?
Ok, schiaccia condividi schermo, Peter, in basso su quello verde.
E poi mi c'è host disabled participant screen sharing, quello sei tu.
Aspetta.
You have to enable it.
Prova adesso.
Host disabled. O devo andare su qua?
No, no, condividi schermo in basso a destra.
Screen sharing.
Esatto, esatto.
Ah.
Perfetto.
And now?
E poi scegli quello che vuoi condividere.
No, that's not the one.
La tua presentazione che devi apri. Ok.
We're looking for it. Oh. Ah, that's the one. Super, super, we made it.
Ok, ma io non vedo la condivisione adesso.
Ah, nessuno lo vede.
No.
Very good. Try again.
La tua presentazione è aperta comunque. Dietro lo schermo. Ce l'hai aperta.
Adesso qui c'è, la vedete? No, adesso non c'è più. Can one see that?
No, no.
No.
Se tu vai sotto su condividi schermo, quello verde,
Sì.
e lo schiacci, e poi hai diverse possibilità puoi condividere quello che vuoi.
Se
no, Sasha, vuoi provare a caricare tu e poi girarle su indicazione di Twitter, non so.
Sì.
Was ist das für eine Sauerei?
Aspetta.
Ist es das da? Das ist es.
Ja, aber es zeigt nicht.
We are still trying.
Sì, nessun problema.
My bullet, questo. Yeah.
Aspettiamo qualche secondo, poi casomai le condivido io. Ma il PowerPoint è aperto.
PowerPoint, come lo posso mettere qua che anche gli altri lo vedono?
Esatto, devi fare in basso, esattamente, c'è quel pulsante verde.
Yeah.
Share screen, condividi schermo.
All panelists. We can all panelists. Adesso è giusto, no? All panelists. Ci siamo.
E dopo schiaccia condividi.
Host only all panelists. No punti.
Ecco.
Ah, adesso c'è.
Perfetto, perfetto. Adesso c'è.
Ah, perfetto. Adesso io non li vedo.
Adesso l'hai appena tolto. Rifai quello che hai appena fatto. Vorher haben wir es gesehen. Genau nochmal das machen, was ihr vorher gemacht habt. Genau. Ecco. Perfetto.
Perfetto.
Voilà.
Se parli in tedesco funziona subito.
Perfetto.
Perfetto.
Perfetto. Mi scusate. So I'll continue short in English, and I think what I would like to do here is a little bit to reflect on the Swiss perspectives on the global minimum tax. And as I said before, I would leave out here and really skip Pillar 1 for the time being, because Switzerland being what it is, I have frankly no clue how we will go about implementing Pillar 1. And I think that again, as has been said by Reuven and by all other speakers, may raise delicate treaty issues. And so I will concentrate, to my mind, on what is Pillar 2. I'll talk about the global minimum tax in general. I'll give some views on Swiss corporate tax and make some conclusion remarks. Core element of corporations will have to pay the fair share of income tax, and we are here with the global minimum tax. Core element being global anti-base erosion rules applicable to groups with revenue of at least euro 750 million. And here there is a huge dispute already because under Swiss rules, it has been said that this just hits or touches on a very few Swiss enterprises. However, I think the number is much bigger than the one which has been anticipated. And then the common denominator about these 139 jurisdictions obviously is US GAAP or IFRS rules will determine the effective tax rate. Swiss GAAP, which is number 17, allowing for the annual depreciation of up to 1/3 of inventory, may, however, remain applicable just for domestic purposes. In addition, we have to distinguish between nominal and effective tax rates, because in Switzerland, corporate taxpayers can deduct the cost of the tax from taxable income. I don't know to what extent this is a particular Swiss rule or as to whether this applies also to other countries. We have two interlocking domestic rules together with the GloBE rules. There is an income inclusion rule and there is an undertax payment rule. And we have then on top of it, the treaty-based rule refers as the subject to tax rules. Now, if here I skip just a little bit and I go further, then there is, and as I have already said, there is this alignment with the guilty coexistence where sort of in the Swiss approach to this global, in the OECD approach, in the OECD approach to this guilty, there is this sentence which says this consideration will be given between, or they will make a coexistence within GloBE rules and US guilty tax. And really this has a bit, astonished me, because this really means, to my simple knowledge, that here really the United States, as far as guilty is concerned, and the OECD, as far the global minimum tax is concerned, they somehow cooperate with each other. And this means that there is an international cross-border. For international cross-border purposes, the US remains the source or the measure of all things. But that also means that somehow the America or the United States are paying a lot for the OECD. And obviously this compromise has been made between the two of them. And that's how this link came about it, which to my mind shows the limited extent of what we are talking about here. Now, Swiss corporate tax rate, if they trigger in here, and the standard answer, obviously, from the Swiss purpose will be that this may vary from canton, from canton to canton, and from municipality to municipality with any given canton. It matters whether the corporation has its Swiss residence, for example, and if we look at the Cantone di Ticino, Astano, Bellinzona, or Lugano. Switzerland is the only country in which the federal government levies significantly less taxes than the cantonal municipal governments. And here I think we can correct roughly 30% goes to the Confederation and 70% goes to the cantons and municipalities. And as I mentioned, in addition, we have to distinguish between nominal and effective tax rates, because in Switzerland, corporate taxpayers can deduct of their cost from the tax from the taxable income. And this then gives rise to this whole discussion of the Swiss law, which is the effective tax rate. And here I just took the example of the federal income tax, which has a nominal rate of 8.5% and which has an effective rate of 7.83%. And then I just gave another example of the city of Zurich, where we have a nominal rate of 26.9%, which then gives rise to an effective rate of 21.2%. Now, what here matters really is that we have, and I take this now for sort of settled, although Reuven said it is far from being settled, but I'll take this 15% tax. And really then the question is, if we have a 15% effective tax, how much would then be the nominal tax? And here I raised it and looked it up a little bit today. And I would say this is about 17.6% of nominal tax, which then would have to apply to all Swiss cantons in order to streamline and taxing and being online with the rate settled by the OECD. And here there is a famous table of cantons and really the corporate income tax rates in the cantons, and these are the effective rates 2021. And if we look at these rules, then we see while some cantons levy corporate income taxes at the rate which is above 15% effective rates, some other cantons levy tax at rates which are below 15%. As the cantons are free to determine their own tax rates, the global minimum tax of 15% will force some cantons, but obviously not all, to increase their cantonal municipal tax rates. Changes in cantonal tax rates are subject to a non-mandatory popular vote, which we call referendum, and it is likely that the cantons will not be in a position to change their corporate tax rates in time, which the OECD sets the effective beginning is 2023, but others of the 139 or 136, I forgot, signatories will also be late. We will not be the only one. Now, while some cantons, such as exempli Grazia Obwalden, and we had a visit from their cantonal tax department or from their cantonal promotion department the other day. So Obwalden has an effective tax rate of 12.74. We'll have to change their cantonal tax laws, and some other cantons, such as exempli Grazia Ticino, will be in a pole position because they have an effective tax rate already now of 19.6%, so they can just sit there and do nothing and wait and see what happens. Now, how can the US force Switzerland or its jurisdiction in time to adopt the OECD Pillar 2 proposals? And here, Reuven contradicted this, and he said, you know, this is no longer something which is in the forefront, but until a few months ago still was. Now there is this, this idea of the shield tax, which means that, you know, beat is down and shield is up, but apparently the shield tax is no so much something which is discussed in the US and has been put in the back burner. So the effect of the shield tax may not be as presented here in this slide. But concluding, and then I think we are over with today, concluding Switzerland, and I think will not be the only country who will not implement Pillar 2 in time. Beware of shield, but this is, as again, it was done before. I had heard Reuven Iona tonight. And will Switzerland be among the winners or the losers? I think as far as Pillar 2 is concerned, to my mind, Switzerland will no doubt be among the winners because the cantons, they can adopt easily and change their tax laws so that they are then in line with the OECD limits. And the thing is, how can one force the Swiss cantons to do that? That's very easy. I think for cantons which will not be implementing these measures, there sooner or later will be a blacklist on which, you know, either you take it or you leave it. And if you prefer to leave it, then you're blacklisted. And I think this will put a lot of pressure on the cantonal governments to change their Swiss tax rates. But to my mind, the system as it is proposed now, and obviously Switzerland has no such thing as this excise tax, which has been discussed by Nicola, and we are not members of the EU as well. So to my thought, many EU member state companies which are resident in Ireland and elsewhere may consider to even, you know, come to Switzerland, because here we are independent from the EU and we may do better in various things than the EU does. And obviously we are less restrictive and less restricted. And with these words, I would like to thank you, everybody. And I think if there are any questions, I'll be glad to answer them. Otherwise, I think we will simply close today's seminar. Are there questions?
So very quickly, Peter, I really enjoyed your presentation. I was about to ask you, what is the Swiss position about the pillars in the American proposal? But after you have shown us the differences between cantons in terms of rates, etc., my question would be, well, can Switzerland, the federation, can have a position about this?
No.
Or the differences between cantons are so strong that for the federation is not possible to keep
Also,
clear
the
position?
Swiss cantons are absolutely independent in fixing their own tax rates. The Confederation cannot issue anything by way of which they try to fix tax rates for the cantons. This is the cantonal sovereignty, which is preserved ever since, and I think it will continue to be preserved. So the only way of talking the cantons into changing their tax law is that they have by themselves to change, but the Confederation cannot force the cantons in any way or fashion, to my mind, to change their own tax rates. We have a federal law which sort of aligns all the cantonal tax systems and puts them into one big basket, and that works perfectly well. But part of that big basket are not the rates, and the rates are still determined by the cantons. And here I think the Confederation has nothing to interfere and nothing to do with it.
So for the Confederation, it's very difficult to represent cantons in the international arena because different cantons have different agendas. Am I right?
Yes, so the different cantons, they have different agendas. This may be true. But as I again said, you know, within the scope of the federal law, which aligns all the cantonal tax system, these different agendas, they're narrowed down considerably and they're not very big anymore. However, I think that what happens here, and we saw it the other day, cantons all in a sudden start to detect, you know, that here we are in competition with other cantons. And so you have delegations from various cantons who come to see you and visit you, and all of them promote their own canton to be the very best in Switzerland. And that's why it is a bit of difficulty. But obviously, I think for the Confederation, you know, the treaties and all that obviously are dealt with at the federal level and not at the cantonal level. But here we are, to my mind, not discussing any treaty issues. And again, here, I think the cantons, they're absolutely independent.
Thank you very much. Thanks.
Any more questions?
Thank you.
Then I would like to seize the opportunity and thank all the speakers, and especially the European speakers who I understood clearly what they have been saying. And I think this has been, again, an excellent promotion for, obviously, SUPSI. And I hope that we can do this sort of conference in 1 year again. We have a certain tradition doing it. We did it this time, I think, for the 4th or the 5th year. And the audience each time is a little bit bigger. So I think we'll gradually succeed and make this a really big success. And with these words, I would like to thank very much everybody who participated today and wish you all a good night. Thank you.
Yes. Thank you.
Thank you so
Grazie
much
a
for
tutti.
the hospitality. Thank you.
Grazie a tutti e grazie ai partecipanti ancora in linea.
Grazie.
Buona serata e buon aperitivo a tutti e a presto. Grazie.
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 Ciao, arrivederci.